Good morning. I'm Albert Brink from the Cape Regional Office of Productivity SA. I'm the regional manager there. And the purpose of my discussion today will focus on productivity as a growth strategy. The importance of this at this stage of our economic life is that traditional sources of revenue and traditional sources of income are all under pressure. Markets are shrinking. People's disposable income is going down, so most businesses are finding it hard to grow their profit. And there's a very underutilized opportunity called productivity, which if we can improve that, we can actually improve profitability without selling one single more unit at one single rand more. The biggest opportunities for productivity improvement today lies in the back office operations, the administrative operations of organizations. If you look at productivity, it is the heartbeat of a competitive and prosperous business. There's an inextricable link between productivity, competitiveness, and prosperity. You have to be productive to be competitive. And you have to be competitive to be prosperous. You cannot prosper without the previous. Productivity is a business operations performance measure. But I want you to think of productivity in terms of something called conversion. How well did we manage to convert those inputs into sellable outputs? So when we think productivity, I always say it's the output, which it is. Think of this dividing line as the conversion process. So how well did we convert the inputs? The inputs was converted into outputs, and that gives us the productivity equation. The biggest opportunity lies in the process. Now there are 5 key words in that little explanation up top there. Inputs, as you've said, outputs, the beginning and the end. There's something called processes, which has to be efficient and where you have to utilize whatever you have at your disposal. Productivity, from a, if you want to call it mathematics point of view, is basically efficiency times utilization. Efficiency is, there's a simple formula. In this case, I just use time because a lot of the work we do is time-based work. So time is a resource. You can use any resource. The time allowed to perform a job or a process or a task. How much time do we allow for it? And how much time does it actually take to perform? On the other side of the equation, or the other part of the equation, is utilization. The time that the resource is actually in use, divided by the time that the resource is available. It is the small things that makes a big difference in our productivity, in our ability to convert in a very competitive manner inputs into outputs. Kaplan and Norton says that to create long-term shareholder value, you've got to improve your cost structure, increase your asset utilization, expand business revenue opportunities, and enhance customer value. How easy is it in today's business environment to expand revenue opportunities, to sell more units? Times are tough out there, would you agree? it's difficult to get your sales volume up. And by the same token, you can add more customer value. The other side of the equation, is it possible for you to make better use of your resources? The answer is yes. There's always room for improvement. There's always people idle. There's always machinery and equipment that's idle. Is it possible to improve your cost structure? Yes, it is. This part of this equation is your productivity strategy. That part is a growth strategy. That's where you expand market share. That's where you grow business volumes. But that's the tough side these days. Competition is tough. There's a lot of people that wants to do business in the same space as we do. So you've got to be more productive. So what we're going to look at is productivity strategy, and there's only two fingers. The income statement and the balance sheet. Change in profitability is driven by change in revenue and change in cost. So this change in profitability can stem from something called a change in price recovery. How well can I recover my input cost? My change in profitability can come from a change in output quantities. How much do I produce and how much do I sell? And the change in input quantities. How much labor do I bring in? How much raw material do I bring in? So changes in productivity can also drive change in profitability. So on that side, you've got your price recovery strategy, which is the one that most people pursue quickly. My cost is going up, so I have to put up my prices. On the other side, there's a change in productivity. You can also work at the top there, and I'll show you now another way. Sell less at a higher price, sell more at a lower price, but you can buckle your revenue there, or you can do something at the bottom to change your cost, buy cheaper input material, less of it and cheaper. So let me take you into the quantity effect side, which is the productivity side. Scale effect. Can I produce bigger batches? Can I produce more of the same? Can you capitalize on scale, or do you run a job shop where it's one of a kind, two of a kind? If you run that sort of business environment, scale is different. It's difficult. Look at your resource mix, the input resources. Is it possible to change the ingredients that you deal with? The product mix. Do you know whether all your products are actually profitable? Or do you guess that you're making money on it? On the productivity effect side, there's two things. There's operating efficiency. How much time do I allow? What's my standard? What's my target? How much do I actually use? Those are the 5 levers by which we can manage the quantity effect side, because the price effect side is difficult. If you take those two things about price recovery and productivity, you can draw a 4-quadrant thing. If you have high productivity, which I hope you have, and if you have high price recovery, you find yourself in a situation which we say is too good to be true. Because you know what? People latch on to something that seems to be too good to be true. High price recovery, low productivity, fat cats, monopolies. They can charge us anything because we've only got one supplier. If you've got low price recovery and low productivity, you should definitely try harder. What we should be working towards is to become lean and mean. where you can make a good living and you can make good money with low price recovery, being very price competitive because you are very productive. The DuPont model says, I've got sales income, less all my cost, which gives me my net income, and I divide it by my sales, and I get a net profit margin. That's my return on sales, or net profit before interest and tax, or whatever you want to call it. We call it operating profit. Where do those figures come from? Income statement. All of these figures you get from your income statement. Then on the other hand, you look at your assets, current and fixed, total assets. You take your sales, you divide it by your total assets, and you get something called total asset turnover. Where do you get this stuff from? Balance sheet. So if you take your margin, you multiply it by your asset turnover. What is asset turnover? Just quickly. It's the number of times per year that you turn your assets into sales. If you multiply that two, you get something called return on assets. You know what? Your return on assets is basically your productivity. The top side, that side of the equation, is my income statement based stuff. It refers to operational efficiency. At the bottom you have asset utilization, and we said productivity is efficiency times utilization. So in terms of productivity, we ask ourselves two things. Are we efficiently using all that material? That's a valid question. And how well do we utilize the material? Or do we waste stuff? What is the yield that we're getting? But with this, building this sort of a picture from your income statement and balance sheet, it tells you something. I'm summarizing. To improve productivity, inputs, can I reduce them? Can I get them cheaper? Outputs, do I need to produce this whole product range, or can I perhaps reduce my range? Processes, I'm going to come back to that. How efficient is the process, and how well does the process allow for utilization? And when you look at process specifically, think how the material or information flows through the process. How do I reduce variation in quality, quantity, and time? How do I reduce the throughput time? From the order to the invoice, how do I reduce that time? And a lot of that time is consumed by backroom admin operations, which isn't done properly. How do we measure it? Think swift, which is quick, even flow, and in so doing, reduce consumption. Why do we use so much time to perform something? Reduce throughput time and improve the quality. And it can be done if you look at those 5 levers that I have told you about.